Dan, thanks so much for taking time to come on the show today. Would you be able to give our listeners a little information on your background and kind of how you got involved in real estate?
Yeah, absolutely. Thanks for having me, guys. I started out my professional career as an attorney in New York City. I was a capital markets lawyer, did a lot of high yield debt, bank financings, IPOs, transitioned to working on earlier stage company, mostly tech company financings, and then met a group of guys from the school I went to law school at who were doing something really interesting in the real estate space. And this was kind of following the Jobs Act in 2012 and all this movement into, individuals can invest in real estate when, before then it was challenging, right? It was country club, it was friends and family equity. And that's why, if you actually look at the data as a country, as individuals, we're very much under allocated into real estate, even with all this wave over the past 8 to 10 years of people starting to kind of get exposure to that asset class. Most financial advisors say 15 to 30%, and if you look at most folks, particularly those outside the 1%, that number still effectively rounds to zero. And so this was a group of guys who are saying, hey, the crowdfunding model doesn't make a ton of sense, building up these huge marketplaces. What we want to do is grab, a group of, high net worth, ultra high net worth accredited investors, put them into a private capital network and act really like any other real estate private equity firm does. And so I made the decision, much to the dismay of my friends and family, to leave the cushy law firm life and start a company where I was making about 10% of what I was previously making from a salary perspective. But I did believe in this, and I believed in it because I was a perfect example of the type of person who had capital to deploy, but didn't have the know-how or the resources to actually deploy it into real estate in an efficient way, right? I knew a handful of people in and around New York City that worked on a couple different types of transactions, and some seemed interesting, others didn't, but I didn't really know how to tell the difference at the time. But I wanted the ability to deploy my capital into cash flowing real estate across the country, get diversification in terms of groups I worked with, asset classes, what have you. And so that's when we started this company, Alpha Investing. And we've really been full steam ahead for the past 6 years now, just deploying capital into real estate deals. I think we just eclipsed the kind of $2 billion mark for asset value in our portfolio earlier this year. And we're really full steam ahead. We do a lot of workforce multifamily investing. We do a lot of senior housing, assisted living, memory care investing. We just started doing a good bit of single family rentals. It's a space that we're very bullish on over the next 5 to 10 years. And that's really my story in a nutshell.
What's your role at Alpha?
So it started out with the intention of me being a general counsel, putting together our, form operating agreement and subscription agreement and making sure we were following all the compliance rules. And I think that lasted maybe 5 to 7 days before it became, hey, like, this is an early stage company. You're part of the founding team. Let's do all hands on deck, right? And so, I think my primary responsibility when I take my lawyer hat off, which is probably 95% of the time at this point, is working on sourcing sponsors and deal flow, and then taking that through the execution process, right? Evaluating, underwriting, getting the deal ready to be shared with investors, et cetera. Probably spend a quarter of my time talking to our investors when we have live deals, trying to generate new interest in our platform. We have a pretty substantial wait list right now. We capped our network at 1,000 people just because we didn't want a ton of competition for equity, and we didn't want a ton of people we didn't know in the network. And so there's not a ton of work that we do on trying to bring new folks into the network anymore. Like when we started the firm, it's mostly about building real relationships, with those folks. And so that's kind of where I split my time. And then, there's the business of alpha investing, which is, finding good real estate deals and investing. And then, the business of actually growing a company that does that. And so obviously I spend a bit of my time on the latter as well.
How large is your team at Alpha now?
So we're at 9 full-time people. I think we will probably cap it out at like 11 or 12. That's really always where we landed. And it's an interesting comparison to, some of these, like what I'll call a crowdfunding platform, or even, private equity, where you'll see hundreds of employees. For us, this business always made much more sense when you have a small team. Everyone is kind of highly skilled, and you can generate meaningful revenue and ultimately profit with a small team. And then when you have that small team, all of that incremental revenue as you grow is getting distributed to the members of the team. And it makes a bit more sense from a business perspective. The challenge with these platforms, when you grow to a massive scale where you have 10, 20,000 investors, if not more, is you need to build up these massive teams to handle all of that. And that's just never been our vision, right? Like, we wanted something that felt like real estate private equity from a relationship perspective. And so that's what we effectively built.
Awesome. Now, you mentioned that, like, earlier on, your buddies that you were talking about, they were looking at crowdfunding and they're like, yeah, that doesn't make any sense. What were some of the cons that you saw with crowdfunding, or that you discussed with them?
Yeah, I'm happy to talk about it. This is a topic I actually like to talk about because there are so many, positive narratives about crowdfunding, and then there's kind of the underlying, foundational issues, right? And so I actually worked at a law firm that had what they called a crowdfunding incubator, but it was really just a group of lawyers who were knowledgeable about the Jobs Act as it came out in 2012, and could speak to raising capital through online platforms, right? And the first wave of crowdfunding was in that early stage venture space, right? And that is really what the Jobs Act was intended for. Was we want to find ways to get capital to companies that couldn't otherwise access it, right? And then real estate came along and said, we're going to apply a very similar philosophy, right? And we're going to find deals, we're going to create marketplaces, we're going to let people invest who hadn't historically had the ability to invest for the reasons we talked about earlier, and that all makes sense. And in theory, I'm a huge proponent of what crowdfunding did for the real estate industry. It became a very popular and effective means for people to get allocations to real estate private equity. The challenge, though, that I think we saw in practice, particularly as we were kind of behind the scenes with a lot of these early adopters of the space, is that when you raise 50 plus million of venture capital dollars, you owe rather a return on those dollars, and you owe a venture capital return, which is greater than what you'd expect on a private equity deal or something of that nature, right? And so what that leads to is this incentive to build a very large platform and marketplace. And so now, instead of having 1,000 investors, you want 1 million people signed up on your platform. You want anyone who's on the internet to see your platform and sign up. And then you create this massive marketplace of deals, right? The challenge, though, is that when you are pushing hundreds, of deals a year through a platform, your quality control just kind of goes out the window, right? And from our perspective, like, we wanted to be investing into institutional quality real estate with, sponsors who had experience and track records. But also the deals have to make sense, because anything that we put on our platform, and we probably share 8 to 10, maybe 12 deals a year with our network, even though our investors are ultimately making the investment decision about whether to participate in a transaction, like, we are putting ourselves on the hook, both financially and personally, right? For any deal that we share. And so for us, it was, let's find those 8 to 12 deals a year that come from good sponsorship groups, that make sense, that have strong downside protection and achievable upside. Let's find those deals and share them with this network of people. When you build up, a massive team of, 100, 200 people, your incentive is now, we need to figure out how to pay the salaries of all those people. And the way that we do that is by pushing as many deals as possible, through a marketplace structure. And it shouldn't be a surprise to anyone that quantity takes priority over quantity, or quality rather, at a certain point in time.
Yeah, that type of model, it's so funny because we have been talking about something like that with our own CPA firm recently. But it's funny how that type of model really only works when you're selling seats, like if I build a software tool or some sort of software system, I can sell seats and I can scale the seats very easily. But when you're buying real estate or when you're trying to scale a crowdfunding platform, the profit that you make on each real estate deal is what is ultimately going to come back to you. It's not, you're not selling a seat. It just takes a lot of work to make profit on a real estate deal. And so I can see how you can almost outscale yourself and then end up like just accepting a bunch of low quality deals coming into the firm just to keep cash flow up, which, you know, we've had clients in the past that have done that, and on a much smaller scale, and it just doesn't work long term. Eventually things start to crack, which is really interesting. And, you know, it's also been interesting too, because I feel like crowdfunding was a really big thing even just a handful of years ago, and now I hear like nothing about it on the social networks anymore. It's like, I don't know. I know that they're still out there, but I just don't. Maybe I'm just not plugged in anymore.
Well, I'm not going to mention any names, but like I think one or two of them actually went out of business, or like had to shut down because, you know, deal quality or issues with financing, what have you. So it's
one of them that went out. One of them that went out. They had we were repping one of the clients, and they like gave us all their stuff beginning of March, and then the crowdfunding team was all mad at like sending us nasty gram emails asking why we couldn't get the return done by March 15th. What are you talking about? You got a 2-week turnaround time for 300 investors? Jeez.
Yeah, the K1 process for us is a disaster, just having, 50 plus, syndications. But, it's the natural evolution really of any industry. And sometimes I think people forget, as it relates to crowdfunding, we're still in the infancy, right? The space evolved through the Jobs Act, but the Jobs Act really doesn't apply to a lot of what folks are doing, which is just syndicating, capital, right? And like any new industry, crowdfunding kind of came in and knocked down the wall and said, hey, this is possible. There's a ton of capital behind it. We're going to show you how you do it. And then groups like ourselves and others have kind of come in and said, let's create something that we think is more refined, that's designed for the investor like ourselves, as opposed to, what would be the best fintech type crowdfunding business to build, right? Because we don't actually view this as fintech, right? The technology is very helpful and efficient. You can look at deals online, sign your documents, track performance, what have you. There's nothing actually novel about the technology, right? I know some firms are trying to implement like AI into the real estate underwriting space. Like maybe that makes sense if you're going to look at 2,000 deals a year and you're going to try to share a few hundred of them with your network. But if you're going to, look at maybe 100 plus deals a year and, you're going to invest in 10 to 12 of them, having an individual who's flying out to the property and touring it and the comps makes a ton more sense than, spending, what's probably 20 to $50 million in building out artificial intelligence that can underwrite real estate deals, right? And at the end of the day, this is still very much a relationship-based business, right? For the most part, we don't buy deals that are marketed because the prices, particularly in the market we're in today, are crazy. The number of times we'll get an email from a group that we work with that says, we got a deal in, Dallas, Fort Worth, which is a very hot market. We think we're going to lock it up for 55 million. Let us know if this initial underwriting potentially works for you guys. And then 2 hours later, sorry, it's under contract at 64 million. And, that's not something that happens infrequently in this current market. And so you got to have people on the ground that can find these off-market deals. That's really important. I've gone on a little tangent from crowdfunding, but it all kind of ties in.
Yeah. Well, no, I think what you're kind of highlighting there is just that real estate is it's just a complex business to run from top to bottom, right? I mean, you started at the K1 process, then you went all the way to the finding deals. And we can obviously talk about the K1 process inside and out, and it's way harder than people think. I think people go to these courses or institute online things where they go and they learn how to syndicate deals and do this at scale. And they learn that their accounting budget's $1,000, and we get the tax return and we're like, yeah, that's going to be a $10,000 tax return, and we have to do X, Y, Z, and there's no way we're going to get all these K1s out by March 15th. And by the way, this is with priority service. Like this is our entire team dedicated to you. it's just a lot of work. And I think that it's when, but it's just a good business lesson in general. Like there's nothing against crowdfunding in particular. I love the decentralized approach. Anytime where you can decentralize anything, I'm all about it. But you just also, you have to be careful. You just can't outscale yourself. You can't go and, set assumptions that are just wildly unrealistic. And in real estate, you can do that not only on the buy side when you purchase, but you can do it when you manage, when you rehab, when you start renting. You can do it in your legal, you can do it in your tax. There's just a lot of places where you can mess up, which I guess is true about any company. So tell us what a capital markets attorney is. What does that actually mean? What type of work did you like dive into the work a little bit more?
Yeah, sure. I'm happy to chat about it. No one's ever interested about the capital markets legal world, but I'm happy to talk about it. So, you have companies that exist in various states, some private, some public, that, need access to capital, right? And so when I came out of law school in 2010, there were very few avenues open to companies, in large part because the credit markets were effectively closed. You weren't seeing IPOs at any degree of scale, right? So a lot of these smaller companies, we're going to the high yield space, right? And that can mean 7, 8, 9, 10%, interest rate, corporate bonds, sometimes with PIK notes tied in there. A lot of these were being done for deals that were like pre-revenue oil and exploration companies, right? And other companies just needed growth capital, but couldn't get it, from private equity. They're going to go out and they're going to access the capital markets. And then, at the more common scale, what most people see is something like an initial public offering, right? You're going out, you're selling shares of your company, you're bringing that capital in. And so generally it just refers to, any activity whereby you're bringing capital into the firm and kind of taking your deal out to a marketplace. And then of course, it's the investment bankers that are structuring those deals, packaging them, getting them in front of the right institutional buyers. And so, your job as a capital markets lawyer, first is kind of structuring what is the transaction look like. But the reality is the deals all take a very similar, like market driven approach, right? The terms and the documents all look very similar deal to deal. And so even though I'd probably, bill you for 100 hours of, putting these documents together and reviewing them, the reality is they don't look all that dissimilar from every other document that is kind of out there in the space, right? With varying exceptions. And then, you do a lot of putting the offering memorandums together, and they tend to be like 120 plus pages. And so by the time you've read through for every comma and kind of font comparison, you just spend a lot of time doing what I would call glorified administrative work on these deals. And then, the heavy legal work is negotiating the purchase agreement, between the investment bank who's buying the securities first from the company. And there is a lot of legal work that goes into that process. But at the end of the day, it's very market driven.
And so you were able to take your learnings there and apply them at I'm assuming a much smaller scale, with Alpha being the GC, general counsel, because we have a lot of people that might think general contractor, but that's not what so you're able to take that and apply it to Alpha and bring immediate skills to the table in structuring PPMs, offering memorandums and operating agreements.
Yeah. So my personal story, right? I ran in a very entrepreneurial social circuit in in New York City. And it was at the time when Bloomberg was the mayor, and there was this huge, just movement into this grassroots tech scene. Like there were meetups, 100 of them every night over the city. I'd go to all of these cool, events. And here, I remember when I first moved to the city, I showed up at this event at NYU, and this is before anyone knew who Uber was, and they were kind of pitching their story and what a cool idea. And I went back and I met with these guys, and at the time I was saying, hey, I'd love for you guys to be able to set something up so I can tie my corporate card in and not have to wait 30 minutes to get a car home when I leave at midnight every night from the office. And I came back, and I remember I told the partner I worked for, I said, this seems like a really interesting company. And he's like, no one will ever get in a car, with an unlicensed driver. This is New York City. And I was like, you know what? You're probably right. And I think that mentality became very clear to me in the true white shoe corporate law firm. It's there are types of companies you want to work with, and early stage is not it. And that's effectively why I transitioned to working at the second firm in New York that I worked at, which was much more of a startup, venture. It has one of the largest venture practices in the country. And I really kind of dug into that space. And I think what I realized over my time there is that, as a lawyer, there are a lot of things that go into kind of forming, structuring a business, how you think about growing. But at the end of the day, for me, it was much more interesting to get to put my business hat on, right? And say, how do I grow this company? And so, when I joined Alpha, the idea was like, let's create a foundation that allows us to grow in a legal, compliant manner. Let's look at all the regulatory issues, because when you're in financial services, there are dozens of applicable rules and regulations you have to follow, whether it's how you deal with state compliance issues or the number of investors you can bring into any given entity. These are all things that you have to be thinking about. But beyond that, you want to create something that works for your investor group, right? Because as an investor, I don't really care about the regulatory burdens that alpha investing has, right? I want to deploy my capital into the deals I want to deploy them into, in the amount I want to deploy it. And that's really all I care about. And so a big part of my job is really just bridging that gap between what we need to do and what is appealing to investors, and how do we create something that checks both boxes.
So knowing the other side, right, the actual structuring side, the drafting side, what should an investor be looking at when they look at an operating agreement? Like, what are some of the key things that they should always be checking?
Yeah, so I think there are two answers to this, right? And the first one, I'll keep the lawyer head on as I walk through it, right? It's always important, and my assumption, any real estate deal that most folks are investing into, it's into some type of limited liability entity, right? You don't want to put your personal assets at risk in any way. You want your loss, the maximum loss you can take, to be the value of your investment, right? And of course, nobody wants to lose their principal, but you certainly don't want to end up in a scenario where you're on the hook for some type of disaster that happens at the property, and people are coming back to you looking for capital. And that's just from a general, like, protect yourself from liability. But any deal you're investing in should be doing that already. It shouldn't require you to form a new LLC to invest into a real estate deal, although that's something you should check. And then, the important terms I think to look at, one are kind of voting. What are your rights? Do you have the ability to remove a manager if you and other shareholders think they're not behaving properly, or even if they're just not behaving, effectively? And then beyond that, in practice, is that something that would ever make sense to do, right? And then you always want to look at the waterfall provisions and the fees. I think generally people understand how, a waterfall works, where you're entitled to the first 6, 7, 8% of returns. And then above that, there's a split between you and the sponsor or the manager. But what a lot of people don't fully understand is there are a lot of nuances that can be tucked into that structure, right? And one I'll throw out there just as a high level is this idea of a catch-up, right? Where what happens is the sponsor agrees to those waterfall terms, but as soon as you exceed those terms, there's a catch-up that goes into place. And so if the sponsor was entitled to get 30% above an 8, once you get above an 8, the sponsor gets to catch up, through that, the incremental distributions that are made. And so in effect, if they get above the 8, they're doing a straight 70-30, not a 70-30 above an 8, right? And that's something that's usually not in the marketing materials. That's kind of tucked into an operating agreement, but it dramatically dilutes your return. And now that, listen, there's a question of, what is a market set of returns? I know for us, groups that bring, mid 7-figure checks into any given deal, we're expecting institutional terms, right? But if you're someone that is coming in through a crowdfunding platform and you're writing a $10,000-$15,000 check, like, you might expect terms that are less favorable. And so I think it's important to understand, what those terms are and how they make sense. But at the end of the day, you're oftentimes, as an individual investor, you are a term taker, right? Here are the terms. If you want to invest, go for it, but there's no ability to negotiate. Where for us and other, groups that are deploying large amounts of capital, we're going to come in and say, these are the provisions we need to see in an operating agreement. These are the terms that we need. This is, how our kind of approval rights work. We want to be able to say yes to a sale, to a refinance. We will look at your budgets. We want the right to be on weekly property management calls. We want to do quarterly inspections of the property, right? That's a process, that we go through. But as an individual, you really just need to know what's happening. And then the second part to the question, or the second answer, with the lawyer hat off, is you really just need to be comfortable and trust the group that you're working with, because in a scenario where they do not act in good faith, your recourse is extremely limited in practice, right? Everyone likes to think that if a sponsor does something to kind of screw you over or take advantage of the investors, you're going to go to court, you're going to show them, why they were wrong, and the court's going to say, yes, like, you're correct, and, sponsor, we need you to pay these guys X dollars because you made a mistake. And that's just not how it happens in practice, right? You'll go through probably a year of sending, demand notices and draft complaints before you get a response. And then you file a lawsuit in court and you spend hundreds of thousands of dollars, and maybe 3 to 5 years later, you get the judgment that you're looking for, but it's an exhausting process. And so everyone should know what's in the legal documents. They should feel comfortable that if they need to enforce an agreement, they're able to. But at the end of the day, you have to understand, if you're ever in a position where you actually need to enforce an agreement, it's a bad place to be in.
Can we actually talk about that a little bit more? Like just kind of expand on the actions that an investor can take and what the expectations can be. And I like that you just kind of laid out the timeline. And the reason that I want to expand on a little bit more is I started the CPA firm in 2015. And I started learning about syndications probably around the 2016 timeframe, when people started asking me about them, both on the buy side or on the LP side and the GP side. And there was always this thing of oh yeah, it's risky, you could potentially lose your money and all that stuff. And everybody just kind of blows it off because they're like, it's not going to happen to me. And for me, it's why would people act in bad faith? It's real estate. But then you actually see it happen, and then you see it happen again, and then again, and then again. You see people's 401ks go bust. You see people lose hundreds of thousands of dollars. And I don't know why I just laughed. It's not funny at all. It's more of just a nervous laugh, I guess. And so I think one thing that I have learned personally is that, investing in syndicates and funds is by no means a bad thing. I mean, you can make great returns. You just have to make sure that you just have to understand that you're I've kind of built this belief that you're investing more in the team than the actual underlying asset, because we've seen bad teams which were marketed as great teams, but bad teams turn a great asset into a really bad deal. And we've also seen great teams turn a really bad asset that nobody else would touch into an amazing deal. But I think it's just important for people to really understand that there is actual risk of losing money here, and what their potential recourse is, because you're going to invest a lot of money, and you've got to know that there is risk associated with that. The one thing that I would love for you to expand on in this conversation is, when can an LP take the deal over, and is that a faster course of action or a faster way to get recourse than trying to sue the GP? Because we've seen people try to go the sue the GP route, and it's just kick the can down the road for years and years and years. So can you talk about that a little bit?
Yeah, absolutely. And so, usually there will be some type of mechanism in the operating agreement whereby, the LPs, collectively or through, if there's a majority partner, can replace the manager under a number of circumstances, right? And sometimes it'll just be, if they're acting in bad faith, right? They're clearly stealing money or doing something, and that otherwise isn't kosher, right? And then in other scenarios, it will be if they just aren't performing well, the LPs can, replace the manager, right? I think there are two practical things to think about, though. One, there's almost always going to be a first lien debt in place, and that lender is going to have, similar, if not stronger rights than the LP has. And so in a world where there is bad faith, you have to assume the lender is going to be the first one to act, or if you realize it first, the second the lender does realize it, they're going to be the ones to act, right? And they're going to usually have, priority control over the deal. But let's say it's a smaller transaction, it's a local operator, and you're an LP that actually does have the right to remove the manager in the event they're not performing well. The challenge in practice is that if you remove the manager, you've got to replace them with someone else. And so there's a question of like, who is that? Is there another, sponsor out there that just wants to jump in and take over as the manager of this deal, even though, the economics for them compared to other transactions they're probably working on are not comparable? Are you and the other LPs going to step in and start running the project? And the answer in 99.9% of scenarios is no, right? And so, you may have the actual, means and the legal mechanism by which to replace the manager in these deals. But again, once you get to that point, I think you're already in a very bad position, and it's more about, salvaging your principal at that point. And so my advice, and consult with your lawyer, this is not legal advice. If you run into that situation, look to get a buyout, right? Look to get your principal back and exit the deal. You don't want to be holding an asset that has all of these fundamental issues, because again, most people that are LPs, they are passive LPs, and they want to be passive investors, not active investors. And so, your role, the time you spend thinking about a deal changes dramatically when you're running the project, and it just doesn't make a ton of sense.
So if I'm about to put $100,000 into a deal, or let's assume that I put $100,000 into a deal, how can I verify, so I get a stake in the entity, I signed the operating agreement, all that stuff, but how can I verify that the $100,000 that I just put into the deal was actually used to acquire a property, right? Like, is there a way that I can go and do that check? Because I don't want to invest in a Ponzi scheme, and I'm a trust but verify type of guy. So I'll give you the 100K, but then how do I go and look at whether or not this entity actually acquired, or whether or not the sub entity actually acquired the property?
Yeah, it's a really challenging thing to do in practice, right? When you give your money up, you assume that it's going to the place that you thought it was going to and being used for the purposes that you were told it's being used for, right? The challenge is when you have someone who's, a bad actor or doing some type of Ponzi scheme, the information you're getting from them is probably not accurate, right? And I think the other thing people need to keep in mind as they invest into real estate is there's somewhat of a perfect storm for fraud in this current environment, right? You have all this demand for access to real estate, right? We're on this massive bull run where everyone is seeing, returns that are above projections over and over and over again. And then real estate deals, and this is unique to real estate deals as opposed to other securities like a high yield debt bond, for example, they're marketed based on forward-looking projections, right? You see, this is what I'm supposed to get. Whereas, when you do a high yield offering, there will never be a word about what's supposed to happen in the future. It's all about the trailing financials. Can they support this debt issuance? You would never let someone say, we expect, our revenue to grow by X%. Like that's one thing as a lawyer is an absolute non-starter. And so one thing that was very unique to me as I got into this space, just how forward-looking everything is, right? We're comfortable saying this deal is going to get you a 15% average annual return over 5 years. And it's kind of crazy when you think about it, because, you can look at the deal and say, the underlying assumptions support this position, but you really have to be open and transparent about the fact that there are underlying assumptions that may prove to be correct or incorrect. And a lot of the work that we do is trying to assess the validity of those underlying assumptions to determine if a deal makes sense. And so all of that is just to say, it's a challenging time if you are dealing with someone who's acting in bad faith. Because you also typically don't have, regulatory pressure or some type of, police force that's looking over these transactions, right? Until a deal blows up and investors lose their money and then they go to an enforcement agency, that's the only time where any of these groups are actually going through the process of being held accountable. And even when that happens, oftentimes there'll be a lawsuit, there'll be a settlement. Investors are happy to get their principal back, as opposed to actually going after damages. There are very few situations outside the biggest cases that you hear of where it actually goes through an enforcement proceeding and, the guy who stole everyone's money, goes to jail. And a lot of times what you've seen over the past 10 years is maybe someone takes your 100 grand and they send it to another deal instead of yours, and your deal performs worse than it otherwise would have, but you still got your principal back. Maybe you got a return because we've been in this compressing cap rate environment for so long now. And so you don't notice it, right? Because as an individual investor, you're getting a quarterly report, you're getting your distribution. You're not going back and saying, I want to audit, the property level financials. I want to see how the cash flows through. Maybe you guys are because, that's your space, but the average investor doesn't know how to do that. Or if they do, they just don't have the time, right, to go through that process. And so the unfortunate answer to your question is you really have to trust the groups that you're working with, because the only time you really become aware of these issues is when it's too late.
No, absolutely. 100%. Definitely got to trust the groups you're in when you're investing as an LP. That's always been one of the things that I've always looked at is, the group, right? The group, if you're going to put up 100K or however much money you're going to put up, do you trust that the group is going to do what they say they can do? But kind of, shifting gears a little bit, like you said, this market's been super hot for the last, 10 years, 8 to 10 years. What types of deals are you currently looking at Alpha, and like, how do you make a determination? Okay, this is the type of deal that we want to invest in.
Yeah, it's a really good question because there are a lot of options out there, right? And I think our general strategy is to acquire cash flowing, need-based residential assets, right? And the underlying thesis is people need a place to live. They need a place to grow old. That's true in a good economy. It's true in a bad economy. It's true in whatever economy we're in today, right? And so for us, we focus a lot on multifamily, specifically, value add workforce, Class B acquisitions, with the theory being that in good economic times, people move from Class C to Class B. In bad economic times, they move from A to B. And so in all times, there's always someone in B. And if you can create an affordable product that looks better than the competition, that's a really good place to be in. And so we look a lot in demand markets. We also look in stable tertiary markets, right? The challenge with demand markets, take a Phoenix, for example, is that deals are trading, particularly value add deals that have, potentially have a lot of upside at sub 4 caps, if not lower. And, that just creates a much smaller margin for error than when you're buying a 5.5 cap, right, in suburban Cincinnati. And so all deals like that, when you look at the merits, they can make sense. It's just important they have good downside protection. You want to be able to absorb enough economic vacancy at the property, before you run into an issue, paying off your debt. That's kind of step one. And then beyond there, you want to make sure you can find some degree of achievable upside, right? Because it's not just about protecting principal. We want to earn an economic return, can measure it with the risk we're taking on any given transaction. And so we do a lot of multifamily, different parts of the spectrum, but mostly Class B properties that are already cash flowing. So no ground up construction. These are all acquisitions of properties that have in-place cash flow. We also like the senior housing asset class, specifically the assisted living and memory care sectors. It's a very fragmented industry, meaning mom and pops own a substantial chunk of that space. And typically their retirement is tied up in whatever 1 or 2 or 3 assets that they own. And so COVID has been particularly problematic for those groups that are not institutional managers, right? Because you have to deal with the fluctuations in labor costs as you have to bring in new employees. You have to figure out how to deal with COVID, put different, protective measures in place. You have a lot of folks out, you need temporary labor. And so we're expecting to see a fairly robust acquisition market over the next 12 to 18 months in that space. I think the Delta variant has put that on pause a little bit. Sellers want to be in a position where they believe there's some degree of stabilization. They can sell their assets at a price that they want to sell them at. But we're expecting to see a lot of action there. And then the last area, which is somewhat new to us, and I'll throw a few stats at you that I think are particularly compelling, is the single family rental space, right? About 53% of the total rental stock in the United States are actually single family home rentals. The remaining 46 or so percent is in the multifamily space. And I think that one fact is always really shocking to people. They don't realize how many single family homes are actually being rented in the company. But more interesting to me, if you look at institutional capital and their ownership, they own about 50% of multifamily assets, right? And even with everything you've heard in the news about institutions, deploying capital into the single family rental space, they only own about 2.5 to 3% of the single family rentals in the country. And on one hand, that does make sense, right? It's much easier to buy a 250 unit apartment building than it is to buy 250 single family homes that are scattered across a market and manage them. That makes perfect sense. But as we think about that space, and if you actually go back to the early 90s, the multifamily asset class was not considered a institutional asset class, by any means, right? And today, it's one of the more, if not the most robust, recipient of institutional capital. And so our perspective is that the single family rental space is going to see an influx of capital that's going to drive that institutional ownership up to the 20-25% range over the next 5 to 10 years. And so our strategy there is to go out and acquire 300 to 500 properties in any given market, stabilize, and then sell them off to an institution who wants access to the space but doesn't have the time or the resources to go out and buy, $500,000, $150,000 homes, right? And so that's a big part of why we like that space. We think there's a lot of room to run, a lot of upside. And then if you just look at the properties on a one-off basis, not that you acquire these deals on a cap rate basis, but if you look at our portfolio, they're like 8 to 9 cap acquisitions, which yields really great cash flow for investors right off the bat.
No, that's really interesting. When it comes to debt, kind of as you were going through that, one of the things that we see some groups doing is controlling the amount of debt they take on, like relative to any specific deal. What kind of loan to value ratio are you looking at? At least maybe on the multifamily side.
So I think that's a really good question. And it's one that we get often, particularly whenever we share a deal that has, leverage above 75%, right? Because everyone says that 70 to 75% range is kind of the sweet spot. And in a lot of deals, that is the case. But what you really care about, again, is downside protection. What is your debt service coverage ratio, right? How much room do you have? Because debt can be accretive, particularly at these current interest rate levels, right? Where you're looking at a 300 plus L with a 25 BIP LIBOR floor, right? That's really attractive and accretive debt. And if you can go up to 80% on a deal where you still have a 1.5x coverage ratio in the first year, that deal makes more sense at 80% leverage than it does at 70% leverage, even though in the grand scheme of things, 70% is less risky. It's always a risk reward calculation, right? And where are you getting the best risk adjusted return, assuming in a downside scenario, you can still pay your debt, right? And so there will be deals where, we go up to as high as 80% leverage when the downside protection is there and we believe the debt is accretive to returns. But there will also be transactions that we will buy in all cash. There'll be deals that we buy at 65 or 70% levered because that's where we think the sweet spot is on that transaction. And so the long answer to your question is, or the short answer to your question is, it really depends on the asset and the business plan. But most of our deals are falling in that 65 to 80% range, which is where I think a lot of folks end up.
That makes a lot of sense. So kind of at this point, if someone wanted to invest with you, they're considering funds out there, like, what are you mentioned before, there's about 1,000 people you have in your network. How does someone get involved in that network, or how do they learn more about investing with you if they have something they were interested in?
Yeah. So we have kind of our investor portal, our website. It's alpha.com. And, investors can kind of see a little bit about us there. They can request access through our portal. We do have a pretty substantial wait list, and that kind of goes into some of the reasons I talked about earlier, where you have investor limits into individual transactions. You have you want to limit competition for equity into any given deal, and so we typically go through a process, or we always go through a process where anyone who wants to join the network, fills out a bunch of questionnaires about kind of who they are and their sophistication to investing and their net worth and their current assets, et cetera. And then everyone has to get on the phone with, one of the founders of the firm. And we typically like to spend an hour or so, really just chatting about, who are you, right? What do you do? Where are you from? You have a family. Why are you investing in real estate? Are you already doing it? What are your goals, right? Because the really important thing for us, especially because we have a smaller network, is that everyone's on the same page from day one, right? If you come into our platform and you say, I'm looking for 30 IRR, construction deals and high risk markets, you're never going to see something from us that is going to check your boxes, right? And so we want to make sure we're just all on the same page from day one. So you're going to chat with us, we're going to share our story, and then we're going to dump an unreasonable amount of information on top of you, new investor resources, our portfolio, our track record, all the white papers we've ever written. And we're going to say, take a look through all this stuff. And we want to chat again after you've done it, because you're going to have more questions. And, there's a difference between someone who's a sophisticated real estate investor and how in depth we can go on call number one, and someone who, wasn't all that dissimilar from myself, 7 to 10 years ago. Just like, I know I want to invest in real estate for all the reasons people like to invest in real estate, but I don't really know how to do it. And I don't know how to think about it. And I don't know how to evaluate a transaction. And so we want to make sure we're giving those people all of the information to make a very informed decision about whether or not they want to invest into deals that we're doing. And then if they do, how to think about it, right? And so that's really what our process looks like. It is not a sign up and, a few days later you get access to our deals. We keep a pretty close grip on the projects that we have and who we share them with, but it's all with the goal of creating a group of people who, actually understand what we're doing and are like-minded in the way they think about real estate. Because there are, dozens, if not more, strategies out there that, make sense. And, it's important that if you're investing with us, that your strategy and our strategy coincide. And so that's what we're looking to do as we bring people into the network.
No, that makes a ton of sense. Everything you just said, because at the end of the day, you're really building a community of people, and you want everybody to be on the same page, marching the same way, have the right expectations set from the beginning. So that can't be understated in investor relations. And we just did an episode, our last episode, we talked about the entire K1 process and how to set expectations and all that. We won't go into that today, but if there's any final words or any parting words you want to leave our listeners with before we wrap up for today?
As I think about the tone of what we've been talking about today, I feel like I've made real estate investing sound like a very dubious undertaking, right? And that's not the case in practice, right? Everyone should be looking for ways to allocate capital to real estate in one way or another, whether you're buying a rental property and you're actively managing it, or you're a passive investor who's just investing with a group who knows what they're doing, right? The key thing, I believe, is to make sure you are properly vetting the groups that you're working with, and you're not just taking the information they're throwing at you at face value, right? And hopefully that means someone else who's already invested with that group, has had a good experience, can vouch for them. You want to do the same things that you would do when you're trying out any new service, right? Or even really, as a New York City guy, a new restaurant, right? I talk to my friends. Have you been here? I check out the Google reviews. I check out the Yelp reviews before I say, hey, I'm going to go and spend, my $300 eating dinner at this cool new restaurant. I want to know that it's legit. And that's an oversimplification in a lot of ways, but it's really important that people spend time diligencing the groups that they work with. And then also understanding, if you personally don't have the time, the knowledge, or the resources to vet a group yourself, make sure that you have a party that you trust who's actually going through the process of doing that, right? I cannot stress enough how many shady players there are in real estate. And that's always been, kind of a broad, a high level view of real estate is it's kind of shady when you get down into the weeds, so to speak. And it's just really easy for me to tell you that I've been, crushing it on every deal I've done for the past 10 years, and I'm continue to do it. And there's very few ways for you to figure out whether or not that I'm being honest or not. And so, long story short, finding a way to get access to real estate is incredibly important. You want it as part of your portfolio. You want the diversification. You want the hedge against inflation. You want the tax advantage returns and distributions that come with real estate, but do it in a smart way.
Absolutely. It's great advice. So I want to thank you so much for taking the time to come on the show today, and share all the knowledge with our listeners. I think, like you've been saying, the biggest takeaway here is you need to know who you're working with when you're investing in real estate. So make sure you do your due diligence. It's definitely an asset class you do want exposure to. So thanks again for coming on the show.
Yeah, thanks for having me, guys. Happy to be here.